Good morning, everyone. It is Tuesday, July 2nd, and I thought it would be a good time to give kind of a first half update and a second half outlook. I'm going to go through 24 charts here. You know how I get a few overzealous on how many I want to share. We'll try to work through them pretty quickly, but give you kind of a broad look at what we're seeing, what some of our research providers are giving to us, and share that back with you. So let's jump into it. Okay, so this first chart is a look at rates, right? Interest rates are kind of the story right now. Obviously, inflation is still there, but what the Federal Reserve is doing with interest rates is definitely kind of at the forefront of most investors' minds. People are right now are trying to say, well, rates are now in a downtrend, and if you look at this, technically speaking, it is downtrending since late 2022, and that's a good sign. But what I could argue to this downtrend is we have an uptrend since April of 2022. All right. So, which is that story? This pinching or wedging, as we call it, and which direction rates break out of this is going to be important for the next step in the market. Now, having said that, I think we should zoom out even further and go back to early 2020 and see that rates are in a strong trend upwards, right? So in the shorter term time frames, are we down trending? Yes, but we're definitely in a long-term uptrend that should not be ignored for the long-term trend of rates right now. Looking at rates, this is corporate bond spreads. So AAA rated bonds versus triple B rated bonds. When investors want to take risk, they'll buy lower credit quality bonds to get higher yields. When they want to start de-risking their portfolios, they'll buy AAA or higher credit rating bonds, which causes the prices of triple Bs to go up and the prices of As to go down. Now, this is the spread in between those. And you can see back here in 2022, we started to see this increase right before that in the bond spreads. And then the market obviously rolled back over. This is just investors saying, I don't want to take that level of risk. Well, we're seeing early signs of something similar. It's still very, very early. We had a couple instances here where it spiked a little bit, but this is a little bit longer of a starting to bend upwards in corporate spreads. So this could be a sign that the market is de-risking their portfolios. Still staying with rates, this is the yield curve inversion model trying to share recession risk. We are extremely elevated. You can see any time in history where we got to this one standard deviation or being inverted from the historical trend line, it has always preceded a recession, right? Doesn't mean it has to this time, but we've got 1, 2, 3, 4, 5, 6, 7 instances since 1970 in which when yields do invert to this degree, it has generated a recession. So still something to keep our eye on. People have been calling for this for, 18 months, let's say. Hasn't happened yet. It's definitely something to keep our eye on. Moving to the dollar was the big story in 2021 going into 2022. You can see this huge uptrend. Since reaching a peak at about 115, we have been trending downwards, right? I don't love this trend line because there's not a lot of areas where the market was testing it. It just kind of fell off a cliff and has been moving sideways. But you can see we are starting to poke. If we look at this on a different time frame, I say we're in a shorter term uptrend here, and breaking this trend line to the downside is going to be important for definitely international stocks, but U.S. stocks as well. Staying with the dollar, if we go back again, still in this really long-term uptrend. This goes all the way back to 08 and 2009. A pretty clear uptrend. Not only do we have the peaks lining up, but the valleys lining up, but we have these midpoints line up. You can see in the midpoint of this trend, there's definitely been areas where the market has seen this as an important level. And you can see we're pretty much right in that mark right now. So the dollar is still very much in an uptrend. Shorter term, you could argue it's in a downtrend, but we're long-term investors, so we're looking at the long term of this. Looking at the Buffett Indicator. So this has long been Warren Buffett's favorite recession-like indicator. And what it does is it takes the total value of the U.S. stock market divided by the most recent measure of total GDP. basically saying for the goods and services, our country is producing, are our stocks valued in line with that? And we have reached two standard deviations over historical trend line, or what he would consider to be fairly valued. So this is definitely something to monitor. Last time we were up in this range was in 2000. 2008, 2007 happened. We weren't anywhere close to this. So a recession can happen without this. But 1970s it happened, 2000 it happened. Now here we are again. Now it happened in 2021. We did pull off, but we just pulled back to one standard deviation over historical trend and have now zoomed right back up to two standard deviations over trend. So again, another on the more bearish ledger of the market. And that's kind of where we're seeing, and what you'll see through the rest of this video is, the market's been really strong for the last couple of years. Everything has been pretty heavy on the bullish side. Over these last 3 months, we've started to see more data, more research lean towards the bearish side, right? The bullish side still definitely has the bulk of the let's say positive research, but the bearish side is starting to climb a little bit. This is one of those. On a price to earnings measure, we are pushing that two standard deviations again, fell to the one. Now we're bumping back up to the two. So again, that's on the bearish ledger as well. Mean reversion model. So basically this says that markets are always going to revert back to the historical trend line. That's how we get an average, right? If it doesn't bounce back to the historical trend line, then the averages would just keep climbing. And we know that's not the case. Averages have been averages for a long time, always comes back down. So we're pushing again two standard deviations higher. Looking at the market in general, we've been in a pretty solid uptrend here since late 2022. What I find interesting is we have busted out of this channel, this uptrend channel. And what market technicians will say is, from false moves come fast moves. And the question is, did we break out of this and we're really going to rocket higher? If we do go higher from here off of all those valuation models I just showed you, we're going to be entering this extremely overvalued, bubble-ish type market just based on historical trends. But if this were to fall back into the channel of this long-term trend line, we would consider that, a false breakout and be expecting something pretty negative at that point. So something to keep our eye on. As in regards to stocks, are they making new highs or new lows? So what this chart from Thrasher Analytics shows is how many stocks are making 52-week highs, 6-month, 3-month, and 20-day highs. Now, if you go back to late in 2022, like you can see, we were climbing and then we fell off, market fell. Now, with this most recent start of this uptrend, you can see 52-week highs started to trend up, 6-month, 3-month, 20-day highs. Now, what are we seeing? Market's still trending higher, but we're getting this dispersion in the data, right? Trending downwards in 52-week, 6-month, 3-month, and 20-month highs. This is being confirmed by Archaic Capital, another one of our research partners, seeing this wedge build in the percentage of stocks that are over their 50-day moving average. We're right at that 50, so it's 100% of stocks or 0% of stocks. We're right at that 50-50 mark. We'd say the market's pretty neutral. If this breaks to the downtrend, that's more stocks hitting lows, probably not a good sign for the overall market. So that's two research partners that have pointed something out on breadth, right? Breadth is how many stocks are participating in this market. It's getting fewer and fewer. It's being led by just a few names. But Sentiment Trader also piled on. This just came out this morning. So this is the NASDAQ composite after a 3-year high, right? With less than 40% of stocks above their trend line, their long-term moving average, and more new highs than more lows. More new lows than new highs, right? Less stocks going up. And you can see the data is not super supportive of markets going higher from here. Now, we don't have a large sample size, right? We got 1, 2, these happened back-to-back days. We'll call it 3. And then the 4th time happened just in June, and now the 5th time. So not a large sample size. However, the data is not supportive of stocks going up from here. So this is definitely something from a data standpoint we're looking at and being have a careful, watchful eye on. Some of these returns were pretty bad. So when you have three now research partners indicating, right, Thrasher saying, hey, pay attention to new highs, Archaic Capital, pay attention to new highs, Sentiment Trader, same thing, right? This is definitely something we want to be watching. Archaic Capital has this core risk model that they share every single weekend. You can see it reached this most recent spike. It's not the best chart in the world. It's kind of confusing, but we reached this spike and we rolled over. Now you can see the last couple times we've spiked this high, we have seen a rollover. This was the highest reading he's seen in over a decade. So definitely something to pay attention there as far as risk being extremely elevated. Thrasher Analytics, their kind of core equity model called the Maestro model. Anytime that they're getting bearish signals is represented by these pink arrows. Okay, bullish signals represented by the blue. So we had a cluster of pink arrows. Market fell off in 2022. We had a cluster of pink arrows. It was a little early, but then the market did roll off middle to late 2023. Now, the thing about investing in models and data is the market's going to do what the market's going to do. We had this big cluster of sell signals in early 2024. Market shrugged it off, continued higher. We did see this little dip, but these were too far. These were canceled out. But we're looking for data and analytics, right? Probabilities, right? Just because it doesn't happen one time doesn't mean it's still not more probable than not. And here we are. We're getting this cluster of bearish signals again, and definitely something we want to be monitoring. Let's look at the people who own all of these stocks, right? Insider corporate buy-sell ratio. Right. So the market is made up of stocks, and the people who know these stocks the best are the owners, the founders, the corporate insiders. Now, this is the ratio of how many are buying versus selling. Right. And we are down here in the red line. Okay. Meaning way more insiders are selling than they are buying. These people know their companies the most. So definitely something we want to monitor. You can see we fell well below this bottom red, ultimate sell signal late 2022, right before the market rolled over. And we're here again. This is equal weight S&P 500, right? So we know the S&P 500 has been setting all-time highs over the last couple of months, but what is equal weight? So instead of the S&P 500 just puts the most of your money in the largest stock, right? So Apple's, Nvidia's, Amazon's, Microsoft, and the 499th and 500 stock have hardly any money in them. Equal weight says we're going to distribute our money equally amongst all 500 companies. This is a way to look at the broad market and see how the broader market is doing, how most stocks are doing. Now, you can see when we were going down in 2022, equal weight this is relative strength here on the bottom. This is a momentum indicator. Above 50 is positive, below 50 is negative. While the market was trending down, you can see we spent a lot of time underneath 50 in this negative territory. When the market was going up here in 2023, you can see we spent a lot of time above 50. And now here we are in this extremely neutral zone right around 50 over the last several months. It's trending down. You can barely see that orange line there, but momentum is trending down in the equal weight, but we're not seeing that confirmed with relative strength yet. If we think the market's going to go down, relative strength would need to dip deeper below 50, but it's not above 50 either. So again, another thing to put in that neutral category. This is small cap stocks, right? Why isn't a diversified portfolio, kind of getting some juice going this year? Well, a diversified portfolio is going to have international, which I don't have in this chart, but international has just kind of been ho-hum, not really doing anything. Same with emerging markets. Dollar's been strong, so they're going to struggle. But small caps is a good portion of any diversified portfolio. Go back to late 2020. Late 2020. It was at 2,032. Sorry, you can't see it. Can I make this a little bit bigger? There we go. Late 2020, it was at 2032. Draw a straight line over to today, and it's at 2031. So we're going on 3.5 years here where the market essentially has not gone up in small caps. So just this massive sideways motion. If you have a 10% holding in small caps, 10% of your portfolio has done nothing for 3.5 years. So really hard challenge there. There's a lot of conversation out there, some with our research partners, of rotation, meaning that if we don't go into a recession, these large cap, these high flying tech stocks have done so well, we would expect some rotation out of those into small caps. So, the 200-day moving average is trending upwards. So it's definitely on the positive side, but we're just not seeing anything supportive of small caps going higher, but a worthy thing to keep our eye on. Unemployment, more broad economic situations here. So the blue line is the 36-month average of the unemployment rate, and the black line is the current unemployment rate. And what Sentiment Trader was trying to show here was when the unemployment rate crosses the 36-month average, it's typically preceded a large spike in unemployment, i.e., a recession. This is a way to look at the data. So this says every time the current unemployment rate crosses that 36-month average, here is the rate of return of the S&P 500 1 week, 2 week, 1, 2, 3, 6, 12 months later, right? So you can see 12 months later, pretty neutral, some negatives, some big negatives, but more positives than not. But in this intermediate space, the 2, 3, and even 6 months, more significant negative market returns than positive market returns. We expect this will come out Friday with the payroll numbers, job numbers on Friday. We expect this cross to happen again. Doesn't happen, but it would take a pretty wild number on Friday to not have this cross happen on Friday. So again, if that cross happens, another to the bearish ledger. This one, not necessarily in the long term, 12 to 18 months, but in the shorter, 2 to 6 month time frame, we're seeing pretty significant market returns to the downside. And then the last one, this is the SAM rule. So this looks at the current 3-month average of unemployment rate compared to the 12-month low. And you can see anytime we're hovering around this green line, markets are pretty calm. We're not in a recession, but we get these spikes above the orange line and enter into a recession. It happened back in 2007, 2008, shortly after 2001, early 90s, right? You can see the gray bars mark a recession, and we are pushing this orange line, right? And not only are we pushing it, but with authority is the way I look at that. Like, this is not just kind of trickling up. Like, you look here in the mid 90s, it kind of trickled up and then fell back down. Like, this has been a pretty strong push here over the last 12 months. So another one to look at from an unemployment standpoint. So all in all, it's been a good start to the year. We're going to remain on the markets are going up because that's where the heavy trend line is. But as more data falls into the bearish side, we want to have our eyes open and be prepared. So appreciate you all taking the time. Of course, holler if you have any questions, any concerns. Be happy to answer those. We hope you all have a great second half of 2024, and we'll talk to you all very soon.